Hello and welcome back to Principles of Accounting 1. I am still your host, Dr. B. I appreciate all of you joining me today for a very important discussion on accounting and corporations. When we talk about corporations, it's important to understand the concept of stocks and bonds because this is how the majority of corporations get their funding. And so I want to talk about this concept, and I'm going to show you some real-life examples as well. I have a website pulled up. It's called MSN Money. It's a Microsoft Money website, and I want to show you what that looks like as well in these examples. But before we get started, I just want to call to your attention where we are in the course. Well, welcome to week 7. Okay, this is an 8-week course, so we've made it to the end. Almost. We got 2 chapters to get through today, 2 next week, and then you'll have the final exam. I know, I can hear you already. The final exam? What do you mean, Dr. B? It's only week 7. Yeah, next week's the final exam. It goes by so fast, it really does. So I just want to call your attention where you're in the class. We're in week 7, module 4. Today we're going to talk about accounting for corporations, and we'll talk about long-term liabilities as well today. And then next week, week 8, that's the last week of the course, we'll do chapters 15 and 16, and then you'll also have your final exam. All of the course ends on the 16th. Today is the 4th. So, yeah, that's not a whole lot of time, y'all. So if you are late with anything, behind for whatever reason, you in trouble. Okay, you in trouble. So you have to please, if you're late with whatever, you need to get that done now. There's not much time left. I will not accept anything past the 16th. It's really that simple. 16th is the last day of class. Your final grades will be submitted to the university on the 17th. Okay, I'm not playing games. This is it. So I just want to make sure that you're all aware of that. We're down to the last 2 weeks. So the 16th, last day of class, nothing will be accepted past that day. The final exam is also due on that same day, yeah? So, because remember, this is an 8-week course. This is how 8-week courses work, yeah? So just so we're clear on that, that's what's going on. So let's go ahead and jump into our conversation on accounting for corporations, corporate accounting, the way of saying it. So we'll talk about what a corporation is, how it's made up, and then we'll jump into the nitty-gritty, which is talking about things like stocks, bonds, dividends, retained earnings. And we'll talk about a couple of formulas that are used in valuing the corporation. That's the analytical part. And we'll also talk about how to record transactions using general journal entries. So first, what is a corporation? So a corporation is formed by a couple of things. One is it's formed by what we call a governing document. This governing document is called a formation document, yeah? This formation document basically tells how the organization, the company, the corporation is formed. It talks about the board of directors, the makeup of the board of directors, the structure, the physical structure of the what do you call the name for it? It's in HR that's called a organizational structure, right? It lists out who the CEO is, and then all of the directors, vice presidents, etc. All of that is in the formation, yeah. And so a corporation is its own entity and is created by this formation document, yeah. corporations act as their own person. What I mean by that is a corporation is its own entity. Okay. It acts as its own person. Corporation itself is separate from the owners. What I mean by that is the corporation can get sued, the owners won't get sued. The corporation will, not the owners. They're separate. They're separate entities, separate individuals. The corporation acts as its own person. Know that a corporation is not a living being. It's not physically alive, but it acts as it is. That's what we mean by separate from the owners. The corporation has its own rights and privileges, separate from the owners, separate from the employees. Corporation can either be privately held or publicly held. Here's what we mean by this. A private corporation is not publicly traded. A private corporation is not publicly traded. In other words, Nick and Johnny, they got together and they opened up a lawn care business. Yep. And they decided, we're going to make this a corporation. And so they incorporated. They got the articles of incorporation together, filed it in Delaware because it's a tax-friendly state. And they decided, hey, you know what? We got this. This is a corporation. We can sell shares of the business to our friends and family or colleagues. That will represent shares of ownership in Johnny and Nick's corporation. Okay, that's what it means to be privately held. Though the shares of stock of their company is not on the stock exchange. They're selling shares of their company to individuals through private sale. Okay, that's what it means to be privately held. Public corporations have shares of stock that are bought and sold on the open exchanges, the New York Stock Exchange, the NASDAQ. It could be in the S&P 500 if it's a big company. It could be, on one of the other exchanges like the Chicago Exchange, or if it's an international company, it could even be on like the Hong Kong Exchange or etc. Right? There's a lot of different exchanges around the world. So I wanted to show you just an example of my portfolio. So this is MSN Money, this website here. You can get there by just going to msn.com/money or just search MSN Money in your browser. And you can look at all of the different stocks and indexes, and you can see how the markets are performing. I look at this pretty much every day to understand what my portfolio is doing and how the overall stock exchanges are doing. So Dow Jones Industrial represents 30 of the largest companies in the United States on the stock market here in the U.S. This one right here is the S&P 500. This represents the 500 largest companies in the United States that are publicly traded. The NASDAQ represents the majority of technology stocks that are publicly traded here in the United States. These are called indexes, and they represent the overall value of all of the companies that are on the individual exchanges. Okay. Now, I personally do some investing every so often. And I have a couple of stocks that I really like. I have companies that I really like. And these are companies that I shop at, right? And these are companies that I'm interested in tracking. And so these are just a few of them. But I just wanted to show you what an individual stock of a company looks like. This is all real time. This is happening right now. So all this information is live. It updates every second. That's why you see here on the left, every time it blinks like that, that represents trades being made of the shares of those stocks. And so let's take a look at Microsoft, for example. Microsoft stock today is doing very well. All the stocks are doing very well right now because the market is getting used to some adjustments that are being made right now. So, looking at Microsoft, for example, we can see all of the financial information for this company at our fingertips through this website. So up here at the top, we have the summary, earnings, investors. These represent the changes in the shares, and we'll talk about that here shortly. Sentiment, which is how the market feels about the companies and their performance. The financials, this is their income statement, balance sheet, statement of cash flows. And of course, the key ratios. The ratios that we're going to talk about today, you can look those up for any company, right, on MSN Money. And you can identify very quickly how the company is performing by computing the ratios. The ratios are computed here for us, which is nice, right? I can look at all the profitability ratios like gross profit margin, return on equity. We've talked about that one in the past. Price to earnings, we're going to talk about that one today. But it's a really great website to really analyze the financial performance of a company. And so that's why I wanted to show you this, because when you get into investing, when you get a 401k going at your company, or you decide to start buying individual stocks or whatever, it's important for you to analyze the financial information of the company before you invest, because you don't want to invest in a company that's not doing well. Okay, so that's why I'm showing you this information in real time, because I think it's good information to know, because we're going to be talking about all these things here. So that's what publicly held companies are. They're traded on the stock exchanges. Now, let's say Nick and Johnny, they decide to form this corporation. They set it up in Delaware. They incorporated it in Delaware because it's a tax-friendly state for corporations. A couple of advantages of doing this. It's its own legal entity. So if Johnny and Nick don't do so well and something happens and somebody decides to sue the company, the corporation, they're only suing the corporation. They're only going to be able to go after the corporation's assets. They won't be able to legally go after Johnny and Nick. They'll only be able to go after the corporation. So it's a separate legal entity. The company has limited liability, meaning it can only be sued up to what the company owns. All the company's assets are the liability in the event of a lawsuit. In other words, they can't go after the individual owners. The company has the ability to transfer ownership rights. What this simply means is the individuals within the company can buy and sell shares of the company's stock. Transfer of ownership rights. That's what that means. Corporation has a limitless life. Once it's formed, it's there forever. Okay. The only way a corporation can come to the end of its life is if it's shut down entirely for whatever reason. Classic example would be, I guess, Toys R Us. Okay, Toys R Us shut down entirely at one point. Kind of back now, which is weird, but anyway, the corporation itself was done, right? They went out of business. So, but the only way that happened is the board of directors had to terminate the articles of incorporation and end the business entirely. Yeah. So, but the company was around for hundreds of years. Yeah. So when a company's around for a long time, you're like, how can that be? I know the owners didn't live for hundreds of years. Well, it's a corporation. It's its own entity. It can live forever. That's why it says they have continuous life. Because the ownership keeps transferring with shares of stock. There's no mutual agency for stockholders, which is kind of nice. Basically what that means is that the stockholders don't need to just invest in that company. No mutual agency. And it's easier to generate capital investment. What I mean by that is the company can make and sell shares of stock. When the company does that, the people are buying the shares of stock. That's money coming into the business in exchange for a share of ownership. So I can raise capital funds by selling additional shares of stock. Or it can sell bonds as well. Companies just sell shares of stock. A couple of disadvantages for corporations is that there's a lot of government regulation, especially for publicly traded corporations. There's a lot of filings you have to do with the SEC. You have to file 8K, 10Q, 8K, 8Q, 10Q, a 10K, etc. There's a lot of different filings that are required with the Securities and Exchange Commission that corporations have to do. The governments also regulate them in other ways, around the formation of the company. Another disadvantage, of course, is corporate taxation. In the United States, the corporate tax rate used to be very high. It was hovering around like 30% at one point. Then it went down to the Corporate Tax Cuts and Jobs Act of 2017, I think that was. Reduced the corporate tax rate down to about 18%. It made it more competitive, the United States more competitive in the global landscape. Now I think it's probably hovering around 21% on average. But that's the corporate tax rates are governed by the United States Congress, not by the corporations themselves. So this is how corporations look. This is how they're formed. Employees, of course, those are at the bottom of the pyramid, yeah? Corporations are very what we call top-down. The CEO is at the president level. That's second level above you. President, vice president, CEO, COO, CFO, CIO, etc. All the officers of the company. They sit above the employees. They tell the employees what to do. Makes sense. But who tells those people what to do? The board of directors. The board of directors is made up of independent individuals that work outside of the company. They're usually industry professionals that make up the board of directors. And they give the company direction. Okay. They tell the officers and the presidents how to run the company. Yeah, they give the direction of the company. That's what the board of directors does. Who tells the board of directors what to do? The stockholders. The stockholders of the company control the company. And the way they do that is they vote on who sits on the board of directors. Stockholders vote on who sits on the board of directors. The board of directors operationally tell the president, vice president, and other officers what to do. And then they tell the employees what to do. So that's how corporations work. Yeah? This is the structural makeup of a corporation. Sorry. Darn floating toolbars in my face. Okay. Rights of stockholders. Stockholders, they have the ability to vote on the board of directors, or they can have a proxy do it for them. That's one of the benefits of being a stockholder. They can sell their stock, buy additional shares of stock. They can receive dividends. Dividends are cool. So dividends. Dividends are what stockholders receive based off of the number of shares of the stock that they own. It's basically a small check that they get in the mail every quarter or biannually or annually, depending on the articles of incorporation. Receive a small check for their investment. It's kind of like interest. Yeah, it's kind of like interest. That's how that works. The shareholders will receive a small interest payment, yeah, based off of the shares of stock that they own. Kind of cool. I like it. Not all companies do that, though. That's why it says if any. And the stockholders also get to share in any of the assets remaining after the creditors are paid in a liquidation event. Here's what this means. Let's say you used to own a share of Sears stock. Well, poor you. I don't know why you would have owned a share of Sears stock, but for those of you who don't know what Sears is, it was one of the country's largest retailers. They were formed in the late 1800s, and they're still around today. There's only maybe 100 stores left. They went the way of Kmart, Sears. There's a couple of other big companies that are no longer around. But it was a huge company. They used to have a store pretty much in every city. In D.C., I think they had like 3 or 4 stores at their peak. Now I don't even think they have one. I think they're out of D.C. entirely. Just closed the last one in Maryland. Oh, no, I take that back. I think there's one still open in Maryland. And in Virginia, I think there's probably maybe one left. But they're closing. And so what happened was when they started going out of business, went through the process of what we call liquidation. Liquidation is where the company sells off all of their assets. But in a liquidation situation, what happens is first, the creditors get paid. The creditors are who Sears owed money to. Creditors are who the company owes money to. That's what a creditor is, yeah? And so Sears paid the creditors first, and if there was anything left over, which there wasn't, the shareholders would have received a percentage of whatever was left over in the assets, company's assets. But that's one of the benefits of being a shareholder, is you're entitled to these things, which is really cool. So, and they still kind of do this. A share of stock. A share of stock is a unit of ownership. Okay? It's a percentage of the company. A unit of ownership. That's a percentage of the company. It's called a share of stock. Now, a share of stock is a certificate that serves as proof of ownership of that stock, yeah? He used to send out, now it's kind of digital, yeah? But they used to send out a literal share of, it's like a cardboard paper, yeah? This thing that I'm showing you on the screen for the Green Bay Packers, that's a share of stock. It used to be like literally printed on cardboard, real thick paper, yeah? And it represents the share of the stock that you owned. They would send that in the mail, yeah? It's a certificate. So when the stock is sold, the shareholder signs the back of the certificate, known as a transfer endorsement. It's basically, you know how like when somebody sends you a check in the mail? Well, okay, it's not like Venmo, yeah? It's like if somebody sends you a physical check, paper check. Maybe your grandmother sent you a physical check, okay? Because your grandma didn't do Venmo, yeah? So grandma sends you a check in the mail. That's nice of grandma to do that. Maybe it's your birthday, okay? She sent you a $10 check. So when you bring the check to the bank, you have to sign the back of it, right? It's called endorsing it. It's a transfer, endorsement. So you sign the back of the check, you bring it to the bank, and the bank either, whatever you want to do, cashes it or puts it in your bank account. Works the same exact way. This is where it gets confusing, y'all, so it needs you to pay very close attention to this. So now that you know what stocks are, the company, when it's formed in the articles of incorporation, will authorize a number of shares of stock to sell. When the company is formed in the articles of incorporation, also known as the corporation's charter, it authorizes a number of shares of stock that are available for sale. Okay? The word authorized means number of shares total that the company has. That's it. That's all that means. Authorized. Number of shares total that the company has. In this example, the company has 250 million shares of stock. The company can issue authorized shares to the public. What we mean by the word issued is the company issues shares of stock available for sale to the public. So out of that 250 million, the company can sell, available for sale, shares of stock to the public. The word outstanding means shares of stock that are currently held by shareholders. Outstanding means shares of stock that are currently held by shareholders. These are stocks that are already sold. Outstanding are shares of stock that are already sold. When it's outstanding, it means it's outside of the company. Outstanding, outside the company. Shares of stock that are already sold. That's what outstanding means. I'm going to throw some more terms at you. So bear with me. The value of a share of stock is arbitrary. It's arbitrary. Here's what I mean by that. 250 million shares is a good amount of shares. order for a share of stock to be authorized, it must hold a value. It must be worth something. And what most companies will do is they will value those 250 million shares of stock at a certain amount. It's usually 1 penny. 1 penny. 0.01. And the reason for that is because in order for a share of stock to be authorized, in order to be able to sell it, it needs to have a value. And so the company will apply what we call a par value. It's an arbitrary amount applied to each share of stock when it's authorized. So when we authorize shares of stock, we apply it a small amount to it. It's usually about 1 penny. Each share of stock is worth 1 penny as its par value. Because again, in order for me to sell something, it needs to hold a value. So most companies will authorize each share of stock with a par value of 1 penny. Yep. It's the smallest amount we can do. Yeah. When we sell that share of stock, it's not sold at its par value. We're not going to sell a share of stock for 1 penny. We're going to sell it at its market price. The market price is the amount where each share of stock will sell in the open market. The par value is 1 penny. The market price is what it's selling for on the stock exchange. So in other words, when I was showing you earlier the MSN Money website, a share of stock for Microsoft trading at $120 per share. That's the market price for the share of stock today. Its par value is 1 penny. Its market price is $120 per share of stock. That's for Microsoft today. So that just kind of helps you to understand the difference between what par value is and market price. Now, to make it even more confusing, each stock has a classification. And these classifications have different meanings behind them. We have par value, non-par value, and stated value. Par value, as you already know, is when the share of stock has been authorized. 1 penny. Non-par value means we have a share of stock that has either not been authorized or it's authorized at 0, meaning it has no value. And then stated value means we've authorized a share of stock at a specific amount. I'm going to go into a little bit more detail. We're not going to go too deep. This is not a finance class. This is an accounting class. You would learn all of these things in a finance class. Okay. So for those of you who are interested in finance, based off of today's conversation, you might want to look into taking a finance course. So, stockholders' equity. As you know, there are 4 primary financial statements for any company. You got the income statement, the balance sheet, the statement of cash flows, and then there's this 4th one called retained earnings. Retained earnings might be classified as stockholders' equity on the report. And the reason for that is if the company is a corporation, instead of retained earnings, it would have stockholders' equity. But I'll explain how that works. So corporations have equity. We call this shareholders' equity, stockholders' equity. It includes paid-in capital, which is contributions from the owners. Yeah, we talked about that before. Cash and other assets brought into the company from ownership. And we exchange that for stock. Okay, so if I bring in $10,000, if let's say Nick brings in $10,000 in cash, Johnny brings in a piece of machinery to the business, then what would happen is both owners would be compensated in the form of shares of stock in the company based off of the par value, usually. So in other words, if the par value is, let's say, $1, Nick would receive 10,000 shares of stock, and Johnny would receive whatever the stock value is for that piece of machinery. So that could be 10,000 shares, 20,000 shares, whatever, depending on the value of the piece of machinery. So that's what paid-in capital means. Also included in this report is called retained earnings. You already know what that is. It's net income of the company. Yeah. So net income is at the end of the income statement for each month. Yeah, that's net income. Net income goes to retained earnings. When we close out, through the closing process in the accounting cycle, net income goes to retained earnings when we close out the accounting cycle. Yeah. So, in accounting, it's important that we understand the transactions involved with stock. These are usually general journal entries or adjusting entries, depending on the type of transaction. Here we have a transaction where the company is issuing stock. Okay, issuing stocks. Remember what the issuing means. When I'm issuing stock, it's not the. Go back. I'll show you again what that issuing means. We're talking about issuing. It means that we're making them available to the public, for sale. It's not authorized, we're issuing them. So, making stock available for sale. And so, when that happens, those shares of stock will be purchased. I can issue those shares of stock at either par value, market value, or a different value, non-par, or stated value. So we need to record the transaction for the issuance of those shares of stock. And here's how it works. Take the number of shares, it depends on the value, right? I take the number of shares times, in this example, par value per share of stock. So I'm going to issue 30,000 shares of stock at $10 par stock value. So this is a very simple math here. 30,000 shares times $10 per share. So 30,000 times 10, that's 300,000. So I record the transaction for this. I debit cash to increase my cash by $300,000 because I sold 30,000 shares of stock to the public. At $10 per share, that's 300,000. So debit, cash, 300,000. I credit this account called common stock $10 par value. Common stock is an equity account on your balance sheet. And that equity account represents the shares of ownership. Yeah, that's what equity is. So common stock, $300,000, is credited. So I increased my cash by $300,000 and I increased my equity by $300,000. Now, we're going to talk about this thing called premium and discount. A premium is when I sell a share of stock above par value. A premium is when I sell a share of stock above par value. So, and the reason why I might do this is some shares of stock I can get an additional amount because people are really interested in buying my stock, right? It has some nice qualities to it, so people want it. So if a lot of people want it, I'm going to bump up the price. I'll raise it above par value. So instead of selling a share of stock for $10, which is the par value, I'm going to sell it for $12 per share. Oh yeah, now we're talking. So with the transaction, here's how it looks. I debit cash, $360,000. Why? $12 times 30,000 is $360,000. So debit cash, $300,000. Increase my cash, $300,000. Now you'll notice I'm crediting two different accounts. One is I credit common stock at its par value, $300,000. Here's why. Because the stock has par value, I need to allocate the par value to the stock for legal accounting reasons. Yeah. Basically, I need to recognize the fact that I issued that stock. And the way to do that is to credit common stock at its par value. So I credit common stock $300,000. Then I credit this account called paid-in capital in excess of par for common stock. It's a separate account. It's also an equity account. It represents the premium. Because remember, I issued these stock for a premium. Means above par value. So I need to separate those two things out, yes? So common stock, $300,000. Paid in capital in excess of par, $60,000. The $60,000 is the premium that I collected from issuing the 30,000 shares. So, let's take a look at this example. On your shareholders equity statement, which is also known as retained earnings statement. This is one of the four accounting statements, yes? Shareholders equity looks like this. It'll show the common stock, its par value, the number of shares authorized, the number of shares issued and outstanding. Here's the difference again. Authorized simply means this is the total number of shares that the company has. That's it, 50,000. Okay. Authorized simply means the total number of shares the company has, 50,000. The company sold 30,000 shares. They issued 30,000 shares. It's called issued and outstanding because individual stockholders are holding on to the 30,000 shares. That's why we call it outstanding. It's outside of the company. It's outside of their control. The shareholders have them. It's outstanding. So, $300,000 of our shares were issued. So 300,000 is what gets recorded here. How is that? It's 30,000 times $10 par value. Paying capital in excess for par 60,000, because remember, I sold 30,000. 30,000 shares for $12 per share. So I separate the two out. Common stock, 300,000. It's $10 times the 30,000 shares. The 60,000 comes from the premium. The premium's $2 per share. How do we get that? I sold the shares of stock at a premium, $12. Its par value is $10. You take the premium amount, $12, minus par value, $10. That's $2 per share. Premium. So that's paid in capital in excess of par, premium. So $2 times 30,000, that's $60,000. The company had some retained earnings at the end of the month, year, probably month, of $65,000. So we add up common stock plus paid in capital plus retained earnings to get total stockholders equity, $425,000. The total stockholders equity, $425,000, shows up on your balance sheet as total stockholders equity. Sometimes a company might issue what we call non-par value stock. Non-par value stock simply means that the stock does not have a value at the time it was issued. That's okay. Oftentimes, these types of shares of stock are issued to employees of the company. Typically, anyway. So here's an example. Our company issued 1,000 shares of non-par value stock for $40 per share. So this is a very straightforward transaction. We debit cash, $40,000. Credit common stock, non-par value, $40,000. $40,000, obviously it's 1,000 shares times $40 per share. Sometimes the company might issue what we call stated value stock. Stated value stock simply means that the company applied a value to each share of stock. Sometimes this might be based on the market price. So here we have an example. Our company issued the 1,000 shares of stock of $40 stated value stock for $50 per share. In other words, I'm issuing the non-par stock at premium. So if its stated value is $40 and I'm selling it for $50 per share, that means I'm selling it at a premium. So I debit cash $50,000. Why? Because I sold it at $50 per share, 1,000 shares. I credit common stock $40,000. Why? Because the stated value is $40 per share. At 1,000 shares, it's $40,000. I credit paid in capital in excess of the stated value. That's the premium amount, $10,000. How I got $10,000? Obviously, it's 50 minus 40. But another way of calculating that is $10 per share at 1,000 shares. How $10 per share? It's the sale price minus the stated value, $10, times 1,000 shares, 10,000. In other words, there's more than one way to get to that amount, to calculate it. But you see how we got there. Now, let's say Johnny and Nick, they got together to form this lawn company. And so they're bringing together some assets to form the company. They say, hey, you know what? I'm going to bring some land in for our factory or for our warehouse, whatever. The land is worth $105,000. Great. The company says, according to the articles of incorporation, in exchange for the asset, land in this example, we will provide the owner, Johnny, with shares of stock. Okay, seems like a fair deal. So we debit land, $105,000, right, because we're receiving land. The land is an asset, so we increase our asset $105,000. And we're going to, instead of giving Johnny cash for the land, we're going to provide him with shares of stock. So we credit the stock. Now, we're going to give Johnny 4,000 shares of the stock. Its par value is $20 per share. So we're going to first credit the common stock $20 per share. So 20 times 4,000, that's $80,000 or worth of share stock. But that's not all of it, obviously. He gave us $105,000 worth of land. We got to give him more. So, of course, we're going to give him excess. So, we're going to give him another $25,000. How do we calculate the $25,000? We took the land, 105, minus the common stock at par value, 80. That's how we got to $25,000. Issuing stock for non-cash assets. Just like we did with the land, we didn't give Johnny cash. That's funny, I didn't think about that until I just said it. We didn't give Johnny cash. We gave Johnny shares of stock in exchange for the land. You can do the same thing with expenses. So let's say at the beginning, where Nick and Johnny were forming the company, Nick said, hey, listen, I'll take care of all the legal expenses on my end to form the company. I'll take care of the lawyer's fees and incorporation fees and all the other expenses that we take to get the corporation started. That's nice of Nick to do that. So Nick's paying for it out of his own pocket. So instead of paying Nick back cash, we decided, hey, Nick, instead of paying you back in cash, we're going to give you shares of stock. Okay, cool. So we debit organizational expenses, $12,000. These are just expenses that go on the income statement as expenses. And we're going to credit Nick his account for common stock. So we decided to give Nick 600 shares of stock at $15 per share. So the par value is $15. At 600 shares, that's $9,000 worth of stock for Nick. But obviously that's not enough. He cared $12,000 for us, so we got to give him the rest. So we give him in excess of par value $3,000. $12,000 minus the 9, that's $3,000 left, yeah. That's how that works. So I know it's complex, isn't it? It's not very easy. But hopefully the way I'm breaking it down for you makes it easier to understand, because stocks can be very tricky when it comes to understanding how they're calculated. Dividends. Dividends are real nice. Some of the companies I invest in have dividends. So once in a while, I'll receive a real small check in the mail. Every so often. It's usually once a year, sometimes twice a year, sometimes once a quarter. It depends. So what happens is the board of directors, they get together. They'll say, you know what, we gotta take care of our stockholders. We gotta give them a little something, for being stockholders. So what they'll do is they'll provide the stockholders what's called a cash dividend. It's kind of like a interest, kind of like interest. It's not the same as interest, but it's similar. So cash dividends similar to interest. They'll say, okay, I'll provide you with a cash dividend in exchange for your investment. You were nice enough to purchase a share of stock from us. We'll give you a little bit back, because you're awesome. And so the company needs to have obviously enough cash on hand to be able to do that, but they also need to make sure that they have enough in their retained earnings in order to pay out dividends. These two things must be true in order for the company to pay out dividends. So 3 things happen with dividends. Number 1 is the board of directors, they get together and they say, okay, we're going to issue dividends. So they vote on it. They call this date when they vote on it the date of declaration. This is simply the date of when the board of directors decided, yes, we're going to issue a dividend. It's called the date of date of declaration. The company votes on it, and then it gets entered into the accounting record. That's called the date of record. No entry required for that. And then another date that's important is the date of the payment. These are the dates the checks went out to the shareholders. We'll walk through the examples. So the board of directors got together and they said, okay, we're going to issue at a $1 cash dividend to our shareholders for the 5,000 shares of common stock that we have outstanding. Remember, outstanding means these are the shares of stock held by the shareholders. It's outstanding outside the company. So $1 per share of dividend for 5,000 shares outstanding, that's $5,000. Okay. The dividend will be paid on February 1st. Date of record is January 22nd. So since this is a date of declaration, I make a journal entry for this. On January 9th, the board of directors made the decision to do this. So I debit retained earnings to reduce retained earnings by $5,000. And I credit a liability account called common dividend payable. Common dividend payable. This means I'm going to pay this to my shareholders at a future date. Common dividend payable. So debit retained earnings to reduce retained earnings, and credit common dividend payable to increase my liability. I don't need to make an entry on the date of record. I do need to make an entry when I pay my shareholders. So on February 1st, I pay my shareholders. I credit common dividends payable, the liability account to reduce it, and I debit common dividends payable to reduce the liability, and I credit cash because I'm paying them, $5,000. Sometimes a company might make a mistake. It causes a deficit. A deficit happens when a company has too much losses and they paid a dividend in the same year or in prior years. Yeah, that happens from time to time. Sometimes a company doesn't do well for a couple of years, but they either still paid the dividend out or they're holding off on paying the dividend out. So it creates what's called a retained earnings deficit. It's when the company is not generating enough retained earnings to pay a dividend. So what does it look like on the statement of stockholders' equity? We have the common stock at par value. We have 5,000 shares outstanding at $10 par value. So 5,000 times 10, 50,000. This year I have a retained earnings deficit, meaning I had a loss. 6,000, which means I have a total stockholders' equity of 44,000. I don't have enough to pay my dividend to my investors, to my stockholders. When that happens, we accrue the dividend payment over time. We'll pay them when we have enough funds. Sometimes, instead of paying out a cash dividend, a company might decide to issue more stock to the current stockholders. Call this a distribution of the corporation's own shares to the stockholders without receiving a payment in return. It's called stock dividends. Used instead of paying out cash. It's also used to control the market price and keep the stock affordable by having more shares of stock outstanding. It's called diluting the stock market. Diluting the stock. Yeah, that's another term you'll probably hear. For small stock dividends, the distribution is less than 25%. For large stock dividends, it's greater than 25%. It's just rule of thumb. When we record a small stock dividend, we debit retained earnings, credit common stock dividend distributable, and we credit paid-in capital in excess of par. What this does is we're recognizing that we're using our retained earnings to distribute additional shares of stock to the current stockholders. So we debit retained earnings, credit common stock dividend distributable, and credit in capital in excess of par. This part on the bottom, it shows you what happened before the dividend was declared, the balances, the date of the declaration, the date of the payment, and then the ending balance. What this shows us on the bottom. Basically shows you the effect, on stockholders' equity. A date of distribution, when we're distributing the new shares of stock to the current stockholders, we debit common stock dividend distributable, and we credit common stock at its par value. With respect to a large dividend, we debit retained earnings, and we credit common stock dividend distributable at whatever percentage is declared. In this case, in this example, 30% was the percentage declared. Sometimes a company might do what's called a stock split. This happened to me one time with Starbucks. I had a bunch of shares in Starbucks stock, and the company decided to do what's called a stock split. What it means is that they take the existing shares of stock and they split them in half. they create 2 shares of stock for every one. It's called a stock split. What this does is it creates additional shares. But they're at the same value. The same value. Okay. So, for example, let's say I had 1 share of stock in Starbucks. It was worth $20 par value. And the company issued what's called a stock split. So what that did is it took my 1 share at $20. It gave me 2 shares at $10 a piece. It's the same value. It just doubles the number of shares. Stock split. Why would they do this? Because they want to dilute the market to have more shares out there. So that way, over time, when the value goes up, they'll buy and sell additional shares. Yeah. Overall, over time, it'll raise the value of the stock. This slide shows us the effect of changes on assets, liabilities, and equity when we have cash dividend, small stock dividend, large stock dividend, stock splits. We can see with stock splits there are no changes. It's just all it is we're increasing the number of shares at the same value. Yeah. Just a nice summary slide. Now, there's a couple of different types of stock. We have common stock, which is stocks that are commonly available to individuals on the stock exchanges. That's why we call it common stock. It's commonly available. We also have what's called preferred stock. Preferred stock are usually reserved for employees of the company. CEOs, CFOs, CIOs, other employees. They typically receive preferred stock instead of common stock. Why is this? Preferred stock does not have voting rights. This makes it so the employees of the company cannot vote for the board of directors. Okay? They can't vote for their own bosses. It doesn't work that way. So employees of the company typically receive preferred stock. This usually has a stated dividend rate. Employees have the ability to receive dividends based off of the shares of stock that they hold. A nice little bonus for the employees, yeah? So that's what preferred stock is. Companies will issue preferred stock over time. The preferred stock can either be cumulative or non-cumulative. Cumulative means that the dividends in arrears that have accumulated must be paid before the dividends paid out on common stocks. This is pretty normal. Preferred stockholders usually get paid the dividends before the common stockholders do. Preferred stock. Non-cumulative typically happens when both the common stock and preferred stockholders get paid at the same time. So here's an example of how it would look. Yeah. So common stock, dollars par value, 50,000 shares authorized, 30,000 shares outstanding, that's 300,000. How 300,000? 30,000 shares issued at $10 par value. Preferred stock, of $100 par value, 1,000 shares were authorized, 50 of those shares are outstanding. So the amount is the 50 shares outstanding times $100 par value. $5,000 in preferred. Paid-in capital in excess is $1,000. And we have retained earnings of $65,000 for that year, giving us a total paid-in capital of $371,000. So this shows you the difference between when preferred stocks are cumulative and non-cumulative. We can see that the preferred stockholders get paid first when the preferred stock is cumulative. When it's not, they basically get paid at the same time that the common stockholders do. This part gets a little muddy, but dividends might exceed the stated amount once the common shareholders receive the dividend equal to the preferred standard rate. We call that participating. And then we have non-participating, which is when dividends are limited to the maximum amount each year. That's the way it normally works. There's just more definitions, yeah. Why might preferred stock be issued? To raise money. Yeah. To boost the average return to common shareholders. Makes it very appealing to investors. And to employees, of course. That's one of the biggest reasons for preferred stock. Last one I'm going to talk about, last type of stock I'm going to talk about is called Treasury Stock. Sometimes companies will buy back stock from the stockholders. Buy back stock from the stockholders. They'll take the stock out of market and keep it in the company. We call that treasury stock. The company will repurchase stock that is before issued to its stockholders. The reason why a company might do that is to avoid a hostile takeover, to reissue employees stock as compensation, or to maintain a strong stock market. Very typical. So when a company buys back stock, we debit treasury stock and credit cash. We're paying cash for the stock that we're repurchasing. So a way of thinking about this is a lot of times a company will pay a premium on each share of stock that it buys back from the stockholders. So let's say Nick owned a share of stock in Starbucks for $10, and the company said, "Hey, Nick, we'd like to buy that stock back from you. We'll give you $11.50. What the company's doing is they're turning that stock into treasury stock, taking it out of the stock market by buying it back, and they're giving Nick a premium, in the form of cash, obviously. So that's very common. It's very common. But this is how it works. And then sometimes that company might sell the treasury stock back into the market or to an employee or whatever. And so in that case, they'll debit the cash and credit the treasury stock. Sometimes the company will even sell that treasury stock above the cost that they bought it at. So they'll debit cash, credit treasury stock, and they'll credit paid-in capital for the treasury stock above par. Or sometimes, for whatever reason, a company might sell their treasury stock below price that they paid for it. Yeah, that happens every so often. In this case, we debit cash, debit paid in capital treasury stock because it's below. Debit retained earnings, we're reducing retained earnings. And we're crediting treasury stock. Get rid of that treasury stock. We're converting it back into common shares. On your retained earnings statement, these are the types of things you'll see on there. Retained earnings, as you know, is a total cumulative amount of net income minus dividends, minus anything that's paid out, will give us net retained earnings. Remember, retained earnings is what's kept in the company. That's why we call it retained. Of course, there's legal restrictions and contractual restrictions with respect to retained earnings. And sometimes we make errors. Accountants aren't perfect. No one is. So when anytime there's an error, we have to make an adjusting entry. And this is what statement of stockholders' equity looks like. Kind of shows you the beginning balance plus net income minus issuance of common stock minus the repurchase of common stock minus any cash dividends paid out equals the ending balance. And formulas, of course. I can't end any type of discussion without a couple of these. Earnings per share. Earnings per share is very well used, highly used when it comes to determining the company's ability to pay a dividend. Earnings per share helps us to determine the company's ability to pay a dividend. So here's how it works. We take net income, found on the income statement, minus preferred dividends, if there are any, that's on the balance sheet, divided by weighted average common shares outstanding. Okay, this gets a little complicated. But weighted average common shares outstanding, the way it works is we take the beginning balance common shares outstanding plus the ending balance common shares outstanding divided by 2. And another ratio that we would look at is called the price-earnings ratio. It tells us the market's expectations for future growth. Okay, price-earnings ratio. This is what analysts use to determine whether a stock is a buy, a sell, or a hold. Called price-earnings ratio. We take the market value of a price per share of stock divided by earnings per share. One of the last ones is called dividend yield. This is the annual amount of cash dividends distributed to common shareholders. Take the annual cash dividends per share divided by the market value per share. Don't worry, if I ask you to calculate any of these, I'll give you the data. Okay, it's just a matter of plugging in the values. Okay, almost one of the last ones. Book value per common share shows us the applicability of common shares on a per share basis. Shareholders' equity for applicable to common shares divided by the number of common shares outstanding. We made it. We suffered through it, but we made it. Okay, let's pause here. I'll stop this recording and then we'll take a short break. Hold on just a sec.